Precious metals as an asset class. It's important to understand this. Precious metals as an asset class comprise 0.5% of the savings and investment assets of Americans across the country. The 4-decade median is 2%. I believe that gold and precious metals assets will return to mean, meaning that demand for them will increase fourfold. I don't have any idea what the impact on pricing will be, but I suspect it'll be much more dramatic than other people think it will be. If you think about the fact that in the year 2000, gold was at $250 an ounce, what is an appropriate nominal value, considering that you value it in a floating abstraction? The only thing I can say is that I sleep way better owning it than I do not owning it. And I don't own it because I think it might go up in price 10%. I own it because I think it might go up in price 5-fold or 6-fold. What's the appropriate price for life insurance? What's the appropriate price for automobile insurance? How about house insurance? I guess it reflects the fear that society has of those events relative to the income that an insurer can get with the policy premiums that he or she have paid. What I can say is that ownership on a national basis at 0.5% is not reflective of the risks that Americans face from my point of view. How much protection you want, whether you regard the asset class as an investment or a speculation. So let's go through the options. I suspect that everybody should start their gold portfolio by owning gold itself. The least troubling, the least risky way to own it. If you are looking at gold as an investor rather than as an insurance product, you should look at the senior gold stocks. You have implementation risk and you have leverage both on the upside and downside. But this requires some risk and it requires some work. If you're a speculator, if you are attracted to the fact that the junior gold mining shares are some of the most volatile securities on earth, securities that can give you 10-fold or 20-fold returns in gold bull markets, understanding the risk and understanding the volatility, and you're prepared to do the work, understanding or differentiating between the good, the bad, and the ugly of the junior gold stocks, that's certainly very fertile ground. It's a business that's treated me very well. But most people can't stand the risk, they can't stand the volatility, and they aren't willing to do the work. So the answer to the question really depends on the psychological and financial makeup of the person asking me the question. People are still, I would suspect, overconfident with regards to the maintenance of purchasing power in bonds, particularly in the long bonds. I think there has to be a market adjustment in long bonds. If you're owning a 30-year bond as somebody who is running, say, a university endowment, you're facing a very ugly reality. As the interest rate goes up, the value of your bond goes down at the same time that the yield becomes insufficient to maintain the purchasing power of the capital that you have entrusted to the bond. This is really, truly an ugly twofer. And if you look at the fact that even at the federal level, we're $120 trillion encumbered, it's very obvious that they're going to have to reduce the real value of that obligation through inflation. They have no second choice other than a formal default. The thing that scares me more than the long government bond is the structure of the debt, the corporate junk debt market in the United States. We've had an explosion of junk debt, and investors have been served well by owning junk debt for the last 40 years. What scares me specifically is the emergence of an asset class in ETFs called high yield or below investment grade or junk debt ETFs. And there's trillions of dollars of this stuff out there. Savers have bought $10,000 or $20,000 worth of ETFs that own junk debt. The problem goes like this. The ETFs are highly liquid, but the securities that the ETF owns are illiquid. And if you get a run on the bank, which is to say, if average Americans become concerned about the credit quality of the country and corporate America, and they begin to sell, to liquidate their ETFs, the ETF managers have to liquidate the underlying securities that are in the ETF, which are much less liquid than the ETF itself. Two things happen. The managers have to sell their best securities, their most liquid securities, first, and they're left with the junkiest of the junk. You could end up with a circumstance like we did in 2008, where the ETF manager calls their broker and says, sell XYZ bond. The top line number is that the U.S. government on balance sheet owes $33 trillion. That's with a T. That's 12 decimal point, 12 data points to the left of the decimal point. But that's not the worst of it. The net present value of obligations of the U.S. government, things like Social Security, Medicare, Medicaid, that adds over $100 trillion to the recourse liability of the U.S. government. So as Americans, we owe each other, or more precisely, the spenders owe the savers, something like $130 trillion. Putting that into perspective, about 5 times nominal GDP. And we propose to service that debt with a budget that's in deficit $2 trillion per year. That's the first part of the nervousness. The second part of the nervousness is inflation and the perception of inflation. When I tried to do a sort of survey of the deterioration of purchasing power of savings in the items that made up my basket of goods and services, I found that my savings were losing purchasing power at about 7% compounded. I would ask your listeners to attempt to do an informal survey of their own. If then you assume that including tax, food, and fuel, that your savings buy you 7% less every year, let's look at the arithmetic around interest rates. The U.S. 10-year Treasury right now pays you about 4.2. In a currency that is declining in real purchasing power by about 7%. In other words, the U.S. government absolutely guarantees that they will make you 2.7 or 2.8% poorer every year for 10 years. In the decade of the 1970s, the dollar lost 80% of its purchasing power from beginning to end. But the asset class that did the best was gold. At the beginning of the decade, the gold price was an admittedly price-controlled $35. At the end of the decade, the price was $850.